All right, before we get into it, just a quick and really important reminder. This is all for educational purposes. It is not financial advice. You've got to do your own research, always. Okay, so today we're going to zoom out from the day-to-day noise and really dig into a fundamental, almost hidden mathematical shift that's happening right now inside the PLAZM protocol. We're talking about a true inflection point, something called the crossover. And it's the moment the entire system's strategy flips from playing defense to going on the offense. So what in the world is this crossover? Well, think of it as the specific moment when the protocol's own automated buying, which is funded by real yield, by the way, becomes more powerful than the selling pressure from new tokens hitting the market. And the word to focus on here is permanently. This isn't a one-day thing. To really get it, you gotta picture this as a constant tug of war between two massive forces. On one side, you've got sell pressure. New tokens are released, some people sell, and that naturally pushes the price down. But on the other side, you have this automated system, the BBB, that uses its earnings to constantly buy tokens off the market, which, you guessed it, pushes the price up. The crossover is that exact moment when the scale tips for good. It's when the buy pressure just flat out overpowers the sell pressure, day in and day out. And the coolest part? This has nothing to do with market hype or sentiment. It's a structural change that's literally baked into the code. All right, let's break these two forces down one by one. First up, let's talk about the sell side, because what's happening here isn't just a random dip, it's a structural and permanent decline. I mean, just look at the trend on this slide. It is dramatic. If we rewind to day 84, the protocol was dealing with 173,000 new tokens hitting the market every single day. Fast forward to today, day 135, that number has absolutely plummeted to just 27,500. And look ahead. In just a week, it's expected to be under 6,000. The downward trend is just undeniable. Do the math on that, and it's an 84% reduction in the daily supply of new tokens. That is a massive, massive relief of pressure that the protocol has to fight against every single day. But here's a really key detail. Not every single one of those released tokens actually gets sold. Not even close. When you look at the historical data, a much more realistic number is that only about 30% of them get sold. The rest? People are restaking them, holding them, or adding them to liquidity pools. So the actual sell pressure is just a fraction of the total release. So if we take that 30% sell rate and apply it to today's releases, we get a real-world number. The total headwind, the thing the protocol is fighting against, is only about $355 a day. Just burn that number into your brain for a minute. $355. Now, you might be wondering, could this just bounce back up? And the answer is no. This downward trend is guaranteed by the code itself. There's a built-in emission decay that shrinks releases every day. People are choosing longer stakes, which smooths everything out. And maybe most important of all, the huge, scary token release cliffs, they're in the rearview mirror. This force is designed to get weaker and weaker over time. Okay, so let's flip over to the other side of the equation now. Force number 2, the buy pressure. And unlike the sell side, this is a structural growth engine. Remember that little $355 in sell pressure? Well, here is the counter force. The protocol's automated buyback and burn system is currently deploying about $1,720 into the market every single day. And look, this isn't magic internet money. It's real yield generated from trading fees from over 8,500 bonds that the Treasury owns. You can see it right here, broken down by pool. Each one is just constantly swapping, constantly buying, adding up to that big number. It is a relentless automated machine. And here's the kicker. Unlike the sell pressure, this force is literally designed to grow. The system is always acquiring more bonds. More market activity means more fees, which means more yield. And the community even recently voted to pump more of its revenue directly into these buybacks. This machine is built for one thing: growth. So we have one force that's in a permanent decline and another one that's built for structural growth. You know where this is going. This brings us to the most exciting part, the crossover math. This is where we see those two lines finally cross. Okay, let's just put the two numbers right next to each other. On the left, we've got an estimated $355 of daily sell pressure. And on the right, $1,720 of automated daily buy pressure. It's not even a fair fight anymore. The gap is already enormous. We can actually measure this with something called the coverage ratio. And today, that ratio is 484%. So what does that mean in plain English? It means the protocol's automated buying is covering all of the estimated selling, and then buying almost 4 times that amount again on top of it. And this is where it just gets wild. This chart projects the coverage for the next week. Yeah, tomorrow's a little heavier on releases, but the coverage is still a massive 371%. But as those releases continue their nosedive, the ratio just explodes. By day 139, we're talking over 1,300%. And by day 142, we are looking at a projected coverage of over 2,000%. On that day alone, the BBB will deploy over 22 times the estimated sell pressure. That's not absorbing pressure anymore, that's obliterating it. So this all leads to the single most important question you should be asking right now. Is this just a fluke? A few lucky days with low releases? Or is this shift actually permanent? Let's dig into the structural argument. Seriously, a healthy skeptic would be asking this exact question. Are we just cherry-picking a really good week here, or has something fundamentally changed for good? It's the right question to ask. Well, the data gives us a pretty clear answer. If we look ahead at the release schedule, not just for next week, but for the next 80-plus days, what do we see? We see clear skies. There are no massive 100,000 token release cliffs waiting for us. That era of huge supply shocks, it's over. And this slide really drives the point home. We don't even have to use today's numbers. We can model a few different scenarios. Even under really conservative assumptions, like what if yields drop and more people sell? The permanent crossover still happens around day 180. But under our baseline, most realistic assumptions, well, it's already happening right now. So what does this actually mean? What happens on the other side of the crossover? In practice, it means the protocol is finally shifting from playing defense to playing offense. Think about it this way. Before the crossover, the BBB was basically a defensive shield. It was helping out, but the price still needed a lot of new, organic buyers just to stay stable. But after the crossover, the BBB absorbs all of the release pressure, and then it just keeps on buying. It creates net positive buy pressure. It's really that simple. The shield becomes the sword. The tool that was once just defending the price floor is now actively pushing demand forward automatically every single day. And this moment, it didn't just happen overnight. This is the payoff from 135 days of disciplined building, of accumulating over 8,500 bonds, of burning nearly 1.4 million tokens. That infrastructure took 135 days to build, and now it runs forever. 135 days of building, 8,563 bonds. And now the lines cross. Not because the market decided to be bullish, because the math changed. The defense that took 135 days to build now deploys faster than tokens are released. The shield becomes the sword. That's the crossover. And it's happening now. And we have to end with this one final crucial reminder. This whole analysis is based on current data and assumptions, and those things are absolutely subject to change. Crypto investments are inherently risky, and the price is influenced by a ton of external factors that go way beyond this model. This was an educational analysis, not financial advice.